Our moderator for today is Ranjit Singh. Ranjit is a trustee of the IVSC and Global Markets Chief at the International Monetary Fund based in Washington, D.C. Ranjit has previously served as Vice Chair of the International Organization of Securities Commissions, IOSCO, and as Chair of the Malaysian Securities Commission. So with that, many thanks, Ranjit, and now over to you.
Hello, everybody. Let me wish everyone a good morning, good afternoon, and a good evening, wherever you're joining us today. As Richard said, we are very delighted to be able to welcome you to this IVSC panel session on the global macro outlook, and extremely pleased that we have such a large audience joining us today. It certainly is going to be a very interesting session. We have some, great experts lined up today, and we'll hear from them shortly. Obviously, this is an interesting juncture where we're meeting after about 2 years of being in a very much restricted situation. You're beginning to see opening up occurring, people beginning to travel again, and it's great that we are beginning to see some of that happen. However, certainly the backdrop of this discussion today shows that there are issues that we are still facing. The recent Global Financial Stability Report that was put out by the IMF, which I was involved in, clearly shows that financial conditions have begun to tighten meaningfully, and we have begun to see that the balance of risks to growth are certainly tilted to the downside. On top of that, inflation appears as a number one concern. Inflationary pressures have been prevalent and more persistent across both advanced as well as developing economies, and leading to some very decisive calls for monetary policy action by central banks, which is not particularly easy given the trade-offs that they are facing of trying to control inflation while at the same time trying to achieve a soft landing, which may be the baseline, but the tail risks towards a recessionary environment or stagflation certainly are becoming much more pronounced. On top of that, emerging markets are certainly facing their own set of risks, highly vulnerable to high debt levels and capital outflows, and we hope to hear more about that. And against this backdrop in emerging markets, the growth slowdown factor in China amid the elevated financial vulnerabilities poses further headwinds. And there are, of course, some medium-term challenges amid the uncertain continuing geopolitics, as well as food security issues in several emerging and developing economies, and the energy security concerns exacerbated by recent events are further impacting climate transition. So, ladies and gentlemen, we are hoping that we hear much more of these issues in the course of the session today. Let me now introduce to you the panelists. We are privileged to have Alistair Darling, who is the IVSC chair and former UK Chancellor of the Exchequer, Jasper Cole, who is a leading Japan economist and former chief economist of Bank of America in Japan, Kieran Swinglehurst, who is the managing director and liquidity risk group leader at Canada Pension Plan Investment Board, and Megan Green, who is a chief economist at Kroll and regular financial columnist. The session today will now begin with Megan, who will provide the backdrop to the discussions, and then we'll have a moderated discussion with the panelists, and we'll then hopefully hear from you as well. Megan, can I pass it on to you?
Yeah, thank you so much, Ranjit. I'm going to try to give a sort of scene setter, global macro overview in 20 minutes. So I will absolutely miss things, and I hope you guys will raise that in the Q&A. Again, you can do that through the chat or the Q&A button. Just to start off, I want to talk about how we're doing globally as different economies off the back of the COVID crisis. Not that COVID is over, of course, but let's look at how we've done up till now. It really depends on what metric you're using. So in this chart, if you're looking at real GDP growth, if you're looking at output gaps, relative to the trend before the pandemic, the US and Japan have actually bounced back. We're pretty much at pre-pandemic levels for output, but the Eurozone and Canada are still lagging behind. They still have an output gap. So based on that, the policy response was fairly successful in the US and Japan, less so in the Eurozone and Canada. If we go to the next chart, if you look at the labor market, though, instead, it's a totally different story. There, actually, the Eurozone and Canada have not only bounced back, they're above pre-pandemic levels in terms of their employment rate, whereas the US and the UK, to a lesser degree, are still lagging behind. That's reflected in the chart on the left. In the chart on the right, it's just a metric of labor market tightness, the ratio of vacancies to unemployment. You can see that the US labor market is incredibly tight. The UK is slightly less so. The Eurozone's even less so. And so based on this metric, the Eurozone and Canada have done a pretty good job. The US and the UK, Japan, a less good job. For what it's worth, after the global financial crisis, we saw the same trend. So the US bounced back in terms of output, not so much in terms of the labor market. If we go to the next chart, what we're seeing is second round effects of inflation then in the US and the UK, but not really in the Eurozone. So inflation is feeding through into workers demanding higher wages. The chart on the left shows nominal hourly earnings. So you can see the US is ahead of the rest of the bunch. The UK is a little bit behind the US, and then the Eurozone much lower. In the chart on the right, the Eurozone has very different wage bargaining mechanisms. It's much more centralized. And so this chart on the right is just looking at some of the negotiated wages as a percent change year on year. And the recent ones have actually been pretty muted, unlike in the US, where we have incredibly strong wage growth, and the UK as well. The blue line is Belgium. I just highlight they've had significant wage growth. It's a very small economy, so it's hardly budging the Eurozone average. But for the big countries like Germany, France, Spain, wage growth has actually been pretty muted. The ECB's big concern, though, is that this won't last. So if inflation remains really high, workers are going to start to demand higher wages in order to be able to pay for things, to maintain their standard of living. And if you wait until you start to see really high wage growth, then you're kind of behind the eight ball. So the ECB will be trying to get out ahead of this. If we go to the next chart. We're seeing inflation across the developed world, but the nature of inflation is very different depending on where you're looking. So I actually pinched this from the Global Financial Stability Report that Ranjit that cited earlier that he worked on. But you can see in the US, inflation is driven not just by energy and food, but by other things as well. And it depends on the month. In the last month, airfares were a big driver of inflation, rents as well. So that's also been a big driver. In the Eurozone and other advanced economies, that's not actually the case. It's overwhelmingly energy and food that are driving inflation higher. And so what we're seeing is that central banks are having to figure out what's driving inflation, whether it's supply side or demand driven, and respond appropriately. If we go to the next chart. We're seeing inflation everywhere again. It's much worse in the US than it is elsewhere. There is an argument for inflation being more demand driven in the US than it is across the rest of the developed world. And I'll talk about that in a little bit. If we just go to the next chart. What we're seeing in the US is not only is there a lot of pent up demand once we defrosted the economy, having put it on a deep freeze following the pandemic, but actually that in the US more than anywhere else, we're buying stuff rather than services. So this is just a multi-decade chart showing consumer spending on goods versus services. You can see there's a multi-decade trend whereby people increasingly have been buying services and they're buying fewer goods, but that's reversed over the past year or so where Americans bought tons of goods, much fewer services. That is starting to reverse again. So that suggests that actually we were buying stuff because we were afraid that going out to restaurants and bars would land us in the hospital. Now that's starting to reverse. But initially, all of our inflation in the US was in goods inflation, not in services inflation. That's starting to shift back. That isn't a cause to argue, though, that inflation is going to wane in the US because services are 5 times the weight of goods in the inflation basket in the US. So we'll continue to see significant inflation, in part because of this demand-driven nuance where we're buying lots of goods, starting to move back to services, but they're a huge weight in the basket. If we go to the next chart, so that's the demand side story. The US grew by 5.5% last year, so it's hard to argue that there was no demand issue driving inflation forward. But there is a supply side issue with inflation in the US as well, and it's mostly out of the US's control, or partly out of the US's control at least. The Fed can't do anything about China's zero COVID policy, can't do anything about Russia invading Ukraine. And what we've been seeing is that there have been supply chain issues in the US as with the rest of the developed world. The supply constraints were easing towards the end of last year, but unfortunately that's reversing as Omicron hit China and as Russia invaded Ukraine. So in the chart on the left, you see survey data for companies. We saw order backlogs and supplier deliveries started to abate towards the end of last year. Supplier delivery times have flattened out and are starting to tick up now. Again, anything over 50, which is the red dotted line on this chart, reflects an expansion. Anything under 50 reflects a contraction. So we're well in expansionary territory, which means supplier delivery times are still getting longer. Order backlogs are still getting worse. Unfortunately, the chart on the right is something that the New York Fed puts out. It's a global supply chain tightness indicator. You can see that we had a few months ago, we had a big tick down that suggested that supply chain snarls were starting to become undone. We're starting to mitigate, but we've had a tick up in the most recent data point. So again, supply chain constraints were easing, but that's not going to continue because of all of these factors that are outside of the US and certainly the Fed's control. If we go to the next chart, there's another supply issue, though, that uniquely affects the US, and that's the labor supply problem. So this is just a chart showing the labor force participation rate for the Eurozone, the UK, and the US. And unlike in the Eurozone, where the labor force participation rate has rebounded to where it was before the pandemic, in the US, workers just dropped out of the labor force and never came back. So there's a big question about how exactly we're going to fill all these jobs, what happened to those workers who left the labor force, and whether they will ever come back. In the past 3 jobs reports that we've had in the US, they have started to migrate back into the labor force, most likely as the pandemic becomes more endemic and as households burn through the financial cushion that they got. So that is starting to abate, luckily. If we go to the next chart, the labor market is incredibly tight in the US, though unemployment is at historic lows. The quits rate is at near historic highs. We have 11.5 million unfilled jobs in the US, which is extraordinary, and we don't have the workers to fill them. So people are starting to come back into the labor force very slowly, but still there's a long way to go before we fill those jobs. And that is driving some of the wage growth higher. Although in the past 3 jobs report, again, wage growth has abated, which is good news. It suggests we're not getting into a wage price spiral in the US. If we go to the next chart, this is just market-based probabilities for Fed rates. The markets expect the Fed to hike rates to around 2.75% by the end of this year. That's an additional 200 basis points of hiking. That is a lot for an economy to absorb. And so what we'll probably see is a 50 basis point hike in June, another one in July, another one before the end of the year, and then maybe a few 25 basis point hikes. It's absolute consensus at the Fed, in my view, that they'll hike straight to neutral, which in their view is 2.5%. And then they're going to wait and see what the data says, because that is a lot of rate hikes, a lot of tightening for the markets to actually absorb, or for the economy to actually absorb. So I do think we'll get to 2.5% by the end of the year. I think the markets are a little bit more aggressive than the Fed probably is. What we know in terms of the history of inflation and central bank tightening cycles is that central banks have to go past neutral in order to lean against inflation. I think the Fed still hopes that some of these supply constraints will ease on their own, and so we'll do some of their work for them in bringing inflation down. But again, they'll go to 2.5%, and then they'll wait and see what the data looks like next year. We'll probably have some additional rate hikes. Ben Bernanke, the former chairman of the Fed, is a really big fan of saying that recoveries don't die of old age. They're murdered by the Fed. And so that is the concern. The Fed's only managed to engineer a soft landing 3 times in its history. And in all of those 3 examples, unemployment started much higher than where it is now. So it's inconceivable to think that the Fed can actually hike rates this aggressively, bring inflation down, and have no real impact on growth or unemployment, which is what their current forecast suggests. That's just intellectually, it doesn't add up. So I do think that the Fed will end up engineering a recession, unfortunately. Generating a soft landing is really difficult. The Fed's trying to thread a needle wearing oven mitts, blindfolded effectively. Technically, it's possible, but it's going to be really hard. If we go to the next chart, the U.S. economy is slowing down, and so I said the Fed will end up engineering a recession. I don't think it's imminent. This chart just shows the size of the fiscal retrenchment that the U.S. is undergoing. This year will be the second largest retrenchment in U.S. history, second only to 1946. So that's a big drag on growth. If we go to the next chart. Consumer confidence and business confidence are also at pretty low levels. Now, I tend to think that we don't need to worry too much about sentiment levels until they start getting baked into the data. And so it's possible this will start getting baked into the data. If we go to the next chart. That being said, I don't think we'll see a recession in the next 12 months. And that's partly because so much cash was pushed out into the economy. So this chart just looks at consumer deposits at all banks. You can see that consumers are flush with cash. In aggregate, the bottom quartile by income has run out of their cash cushion. But in aggregate, the U.S. consumer has a ton of cash. If we go to the next chart. At the same time, in terms of the private sector, corporates haven't really been defaulting. So loan defaults are at historically low levels. And that's on the next slide, also because companies have used the opportunity to build up their cash positions too. So companies are flush with cash as well. This is looking at total cash on hand in U.S. banks among U.S. corporations. We're near historic highs. So there's a huge cash cushion to burn through in the economy before we actually see companies and individuals retrench significantly, pushing us into a recession. Just looking on the next chart at some of these recession indicators, this is the yield curve. The 2s-10s yield curve inverted for 23 seconds about a month and a half ago. And so investors really freaked out because that tends to be a good indicator of a recession coming. Actually, it's not inverted anymore. It's steepened. The Fed thinks that the shorter part of the yield curve is the more accurate part to look at. That's the blue line. You can see it's been steepening up until recently. So these indicators suggest that we're not heading straight into a recession. If we go to the next chart. This is the SOM indicator. It's basically a metric of unemployment. The theory behind it is very simple, that when you get an uptick in unemployment, then you're going to go into a recession. So Claudia Sahm, a former Fed economist, has calculated the right rate to look at over a 3-month average. And basically, it has to tick up by 0.5 percentage points. That's the red dotted line. This is actually the best indicator we have of a recession coming, though it doesn't say when the recession is coming or what the recession will look like. But you can see we're still pretty far off from hitting that dotted line. So that also suggests we're not about to hit a recession imminently. I'm just going to pivot away from the U.S. As the largest economy and talk about Europe. In Europe, the data has been pretty tepid. This is PMI survey data, which you can see is in expansionary territory, but has really flattened out over the past couple of quarters. The hope was that the first quarter would be weak in the Eurozone, but then as the Eurozone reopened off the back of Omicron, the second and third quarters would be really strong. Then Russia invaded Ukraine. And so I think those hopes are really scuppered. If we go to the next chart, you can see inflation is also an issue in the Eurozone, but again, the nature of inflation is very different. While the US really does have a demand component in terms of its inflation, the Eurozone doesn't really. So headline inflation exceeded 8% last month. That's unheard of in the Eurozone. Core inflation is up much less so it's around 4%. Again, some of that is still driven by energy because, of course, energy is required to make all goods. And so even though you're stripping out energy costs and food costs in that core inflation figure, it still seeps into it. So inflation is spiking. The second round effects aren't terrible, but the ECB is worried that workers will start demanding higher wages to maintain their standards of living. And so we'll also be hiking probably this summer, I expect in July. If we go to the next chart, energy costs, of course, have skyrocketed in Europe off the back of the Russian invasion of Ukraine. Actually, gas prices have abated a bit. Oil prices remain elevated, in particular because of the recently announced EU oil embargo, which also hits insurers and shippers. So we'll bring those barrels of oil, some of them effectively off the market, and will push up oil prices globally. So this is a big driver of inflation in the Eurozone. And there's nothing the ECB can actually do about that. But again, they're worried about second round effects. We go to the next chart. Confidence indicators, like in the US, have really fallen. The chart on the left is looking at German business confidence, which really fell when Russia invaded Ukraine, have upticked a little bit, but from very low levels. Consumer confidence across the Eurozone is down as well, though not at historic lows. They're still pretty far down. If we go to the next chart, and peripheral spreads have widened, which is a concern because the ECB has ended its bond buying program, which was the only real way to deal with financial fragmentation in the Eurozone. In my view, that was a massive tactical error. I do expect more pressure to be put on peripheral yields in the Eurozone. The hope was that all of this money from the Next Gen EU fund coming from Brussels, some of it free in the form of grants, some of it loans, would be absorbed and would drive growth in the Eurozone. There are interim reports, though, coming out of the Commission that the likes of Greece and Italy are having trouble absorbing all the funds, which is consistent with history. EU countries are actually pretty bad at absorbing funds from Brussels. And so I don't think we should put as much hope in those Next Gen EU funds as many economists are. I'm just going to pivot to China next. So if we go to the next chart, China's slowing massively. It was partly intentional last year as a government tried to take air out of the property market, tried to pivot towards common prosperity, reducing CO2 emissions, all these long-term goals. At the end of last year, the Communist Party pivoted and said, rather than look at these long-term goals, we're going to focus on short-term growth. And that is also in an environment of a zero COVID policy, which saw a number of lockdowns earlier this year that luckily are starting to ease now. So we should get a slight kickback in growth in China from that. The JP Morgan GDP Now cast has come out and put Chinese growth around 2% for the second quarter of this year. That's unbelievably low. If you had told me 5 years ago that China would be growing by 2%, I would say, what's the world going to do for demand if China's only growing by 2%? That's a hard landing. I think for the year, it will probably end up a little bit higher. If you look at the chart on the left, you can see different components of growth. So retail sales are down, services production are down. It's really fixed asset investment that's been driving growth in China. And the chart on the right just breaks down fixed asset investment by sector. And you can see all of them have been dipping except for infrastructure. So it's really infrastructure spending, but not in property, that's driving growth forward in China, albeit weakly. If we go to the next chart, the zero COVID policy has been a disaster for growth, but isn't going anywhere before November when President Xi hopes to be reappointed at the party conference. This is just a chart showing elderly, or actually showing vaccination rates across the population, but notably the elderly are relatively unvaccinated relative to the developed world. And of course, the vaccine that's been used is Sinovac, which has been proven to not be quite as effective as mRNA vaccines. And so I think while this is the case, and while China hasn't had the major waves that we have, we're going to continue to see zero COVID policy implemented, which means further lockdowns, further supply chain disruptions for the rest of us, and weakness in China. Finally, I just want to talk about emerging markets off the back of this. As the Fed's hiking rates, borrowing costs in emerging markets are rising. As Ranjit mentioned, we're also seeing massive food insecurity across emerging markets. The chart on the left, I've just taken from the Global Financial Stability Report again. It shows overall spreads across emerging markets. They really spiked when Russia invaded Ukraine, then came down, but they're on their way back up again, particularly as borrowing costs for a number of EMs are rising. The number of EM countries in debt distress is elevated at 13 now, which is much higher than we had seen at the beginning of this year. If we go to the next chart, also worrisome is that not only have these EM countries, were they over leveraged before the pandemic, then they had to borrow more to finance their pandemic response. Now they're retrenching while borrowing costs are rising, and the bank sovereign doom loop, unfortunately, has tightened or increased for a lot of emerging market economies. You can see that in this chart. It's the red line. So since the old days of the Eurozone crisis, when we all started really worrying about the bank sovereign doom loop, actually the connection between the two across emerging markets has only increased, which suggests that if one gets into trouble, the other will be brought down as well. So I think the IMF actually will be the center of a lot of action over the next couple of years. With that, I will leave it there and I'll pass it back to Ranjit, who will be watching this from the IMF.
Thank you. Thank you so much, Megan. And that's extremely useful, and certainly you've picked up on all the right issues, and you're absolutely right. Several of those issues are top and center in the discussions that we are having in the fund. But let me very quickly open it up for some reactions from our panelists. Alistair, you've been there before. You've seen these sort of stresses appearing. Can you give us some observations on Megan's excellent overview?
I think what's striking from Megan's very comprehensive overview is just how much the world has changed, even in the last 12, 18 months or so. We are still, in many parts of the world, seeing the effects of the first global pandemic for 100 years. We are seeing in Europe the first major war in 75 years, something that many people thought would never happen again. And of course, we're now seeing the return of the threat of inflation, again, something that certainly the younger generation, just didn't know. And we've got to deal with that. I think the other thing that I think is very striking, and I'll return to that, when I speak a bit later on, is that there is no single response here that's going to fix it. There's been a lot of talk about what central banks should have done or should be doing, and I want to say a word about that shortly. But an awful lot of it, if you look at the energy prices, which have spiked as a result of the war in Europe for the most part, or the food shortages, which are likely to be a major problem at the end of this year and over the winter and so on, that's where we need a touch of the international cooperation that we did achieve 12 years ago in the financial crisis. And again, I might say a word about that. But I think, what Megan has done is just highlighted what an uncertain world that we now live in, where there are so many moving parts here, and an awful lot of them are going to be very difficult to fix.
Thanks very much, Alistair. You're absolutely right. I like the confluence of factors that you were mentioning that's beginning to appear. Kieran, how about you? What's your sense of what you're seeing?
Yeah, I think Megan did a great job and share a lot of sort of Alistair's points as well in terms of looking at the investment portfolio that we have at CPPIB, which is global in nature. A very much a mix between developed markets and emerging markets. It's striking in terms of the scenarios that we run. And again, I'll talk a little bit more about what we do, but just how much of this is intertwined globally in terms of what's happening. So, it's not like this is an emerging market issue or it's a developed market issue. There are markets that are obviously from an inflation perspective, showing signs of going there and are there, and are going to have, and so the kind of central bank action is going to be critical to see what they do next. And I think the real issues of soft landing versus hard landing, as again Megan talked to, are at least from our perspective really interesting, because I think elements of whether that turns into stagflation as well is a question. So I think that very geopolitical in nature, and it's very unique in terms of the different outcomes that could arise here and the probabilities associated around them.
Thanks very much, Kiran. Let me sort of get a slightly different perspective. Jesper, you have a different set of dynamics playing out in your neck of the woods.
Yes, we certainly do. As many people know, Japan is sort of very, very happy and very confident to actually decouple, from particularly U.S. monetary policy. As you know, Bank of Japan governor is very insistent that yes, there has been some cost push inflation because of the deteriorating terms of trade, but that really demand pull inflation is far and few in between. And from that perspective, I actually have a lot of sympathy with that, because we've had many false starts here in the Japanese economy. And for all intents and purposes, the coordination with the Bank of Japan continuing to buy government bonds, and the political leaders just last week passing another supplementary budget of about 0.5% of GDP. I mean, here it's all pedal to the metal, as it were, with both the money and the fiscal policy regime very, very happy to decouple. We can talk about the sort of details of Japan maybe a little bit later. I just wanted to connect back to the excellent presentation there, and sort of highlight a couple of things that we should not forget. Yes, there are new problems, the war, the energy crisis, the food shortage, and yes, these problems are all global rather than national. But at the same time, I do think that some of the positive drivers for growth that we were talking about just a couple of years ago are still very, very entrenched. And first and foremost, we still do have a very positive dynamics of the rise of a middle class across the emerging market world. Yes, there's going to be some reduced purchasing power with rising energy and rising food prices, but the overall positive development, of the rise of the of a new middle class, particularly here in Asia Pacific, certainly is something that every Japanese corporation is very, very focused on. And then the second positive driver on the demand side is actually investment spending. And here are two primary forces, or actually it's three of them. Number one is the infrastructure build, around Asia Pacific is going to continue to accelerate. The second one is that the management of the transition from a carbon-based economy towards, less carbon-dependent economy. Again, massive investment expenditure opportunities that are going to be forthcoming from, from that perspective. And, so I think, add to that a reality of what is actually new. What is new is that every government in the world is now focusing on national economic security as a constraint. And a big part of the restructuring of global supply chains is going to, again, trigger new business investment expenditure. I look at corporate Japan, very, very focused on, yes, reducing dependence on the People's Republic of China, building new logistic hubs, new factories, new supply chains across Asia Pacific, and even in the United States of America. So I think that, we should worry about all sorts of things, but we should also be very mindful of the great opportunities that are being created in the real world, and particularly, the need for accelerated business investment expenditure, whether it's infrastructure, transition economy, transition energy, or indeed, the restructuring of global supply chains. That's something where a capital goods supplier like the Japanese corporations is going to be benefiting very, very nicely.
Thanks very much, Jesper. That's good to be able to have some positiveness to the very sobering outlook. Let me get Megan circle back to you and get your sort of quick couple of quick questions. I mean, you've mentioned that the Fed has to engineer a recession. So this notion of a soft landing is certainly appearing extremely challenging moving forward. But is there an upside risk in your forecast? And if so, can I ask you what do you think it is? And what do you feel as you respond to this that are some of the global macro issues that that people aren't paying enough attention on? And Jesper sort of alluded to some of those, but I just wanted to get your thoughts on those 2 points.
Yeah, so I think the biggest upside risk is that the supply side issues that we've been facing abate this year. And there are some indications that might be happening. I say we, not just the US, but the global economy. So, if China doesn't get hit by another wave or another variant and doesn't have more lockdowns, that could help. If we can manage to figure out how to get around some of the supply chain issues from Russia particularly around semiconductors and battery inputs, that would help. If the U.S. worker does return to the labor force, that would help. This was the Fed's hope always, initially, before they, formally retired the term transitory, was that actually a lot of these things would just clear up on their own. I think actually the Fed still hopes for that. All they can do is really engage in aggregate demand management, which means killing off demand effectively. And that's not just the Fed, but all central banks. And central banks don't really want to do that right now. So I guess the upside surprise would be if central banks hike, but at the same time, some of these supply side issues are just mitigated naturally. And then central banks can stop being so hawkish and can stop tightening short of a recession. I also think that another upside risk globally is productivity growth, which we haven't seen that much of over the past couple of decades. But if you look at survey data in particular, firms in the developed world, at least, have been using the pandemic opportunity to automate and digitalize. That should feed through into higher productivity growth over time. The productivity data is really noisy because we had all these dislocations in the labor markets. Relatively unproductive hourly service workers dropped out of the labor market when we shut our economies down, then rejoined. So there's a lot of noise in the productivity data, and it comes out with quite a big lag. But we could start to see more productivity growth, in which case you could have wage growth. But if workers are also more productive, it needn't be passed through to the end user in the form of higher prices. And so that wouldn't be driving inflation higher. That's an upside risk as well. And in terms of kind of things that no one's looking at closely enough, I think the food insecurity crisis that's coming down the pike is a major one. Arguably, it was food insecurity that sparked the Arab Spring a number of years ago. The Middle East and North Africa are particularly vulnerable given how much they rely on imports for food. And it's not just food because Ukraine is the world's breadbasket. It's also fertilizer. Russia's the biggest exporter of fertilizer, and that will have knock-on effects, I think, as Alistair mentioned, further down the line. So, for example, the crops that are being planted now in Brazil, they're trying to use a quarter of the fertilizer that they normally do. That will necessarily result in lower yields. And so that will be an issue that we'll be grappling with as we go forward. And of course, the first impulse for a number of countries in this world where we have industrial policy and protectionism is to implement export controls. And that just creates more dislocations in the markets. And so unless we can get the major food exporters to come together and say we're not going to have export controls, and we're not seeing that at all right now, I think that the response of a number of major exporters will actually exacerbate this crisis rather than help it. I'll leave it there.
Thanks very much. Thanks very much, Megan. In fact, that some of your points clearly are reflected. And just looking at the chat, we have folks from everywhere, and many of them are also looking to try and get the panel's perspectives on impact across other parts of the globe. and your point on food security, I think, is particularly relevant. I'm just going to turn to Alistair here. And Alistair, given what we are hearing from Megan and Jesper made these points, etc., I'm coming back to something that you said briefly, and you mentioned the fact that that we've talked about international cooperation, and obviously you were in the thick of it when we navigated the financial crisis of 2007, 2008. And given what we are hearing, and some really difficult issues here to tackle with, how important, in your view, is unified action, and are you seeing that happening sufficiently?
Well, firstly, I do attach considerable importance to international cooperation. The responses will be different from exactly what countries do depending on their own circumstances. But I can tell you that in 2008-9, had the world not come together, from communist China to Republican United States, the countries in the Middle East, Japan, Europe, then the outcome of that financial crisis, the virtual collapse of the banking system, would have been horrific. There was a very real risk that recession could become depression. Now, one of the reasons that didn't happen is because right across the globe, countries took similar action to shore up the banking system and, importantly, to support their economies, so that the risk of a total collapse and the likelihood of a recovery were dealt with. Now, I'll just say a word about central banks, because in some ways they've had a bit of a bad press over the last few months, with people saying, look, they should have put up interest rates last autumn. I can quite see why central banks, no matter where they are, were mindful of the fact that at that time, which when clearly the effects of the pandemic were with us, but the war in Ukraine had not yet started, and some of the other things were yet to be seen, they were anxious not to put interest rates up too much, too quickly, because they didn't want economies having emerged from the pandemic to then go into a recession. And of course, since then, you've had the geopolitical problems of the war in particular, which of course have changed people's outlook on this. Now, it's understandable, therefore, that central banks will increase rates, as Megan alluded to. But I think it's important to look at the positives here and what governments together can do. One of the things that they should certainly avoid doing is retreating into protectionism. The idea that globalization has gone away is absolute nonsense, and we live in one world. It happens. It's a question of how you deal with globalization rather than wishing that the whole thing would go away. And I think there are opportunities here. Firstly, you resist the temptation to erect barriers in a protectionist sort of way, although recognizing at the same time that we do need to look at supply chains. We can't get ourselves into a situation where we're so dependent on one source of getting vital equipment and material. And that in itself presents an opportunity for many countries, because they can perhaps look at what they can do, not necessarily at home, but certainly closer to home. I think Jesper mentioned climate change. There is something that countries do need to work together, and there are massive opportunities here as we migrate from the traditional or the energy source we've relied on for the last 100, 200 years to something that's less damaging to the environment in which we live. And equally, Jesper alluded to the fact there is massive spending power, not just in the Asia-Pacific area, but in the United States and Europe and so on. Whether or not that is unleashed in a positive way depends to a large extent on confidence. And one of the things, in my experience, that does build confidence, if people see that governments are doing their best to maximize the opportunities that are open to the people in their countries and avoid doing things that will exacerbate the situation. Protectionism is a very obvious case in point. And perhaps after a decade where countries have looked in on themselves, and there's been a nationalistic approach has been dominant, perhaps that will change. Because we live together on the same planet, we need to cooperate if we're going to succeed and getting through, the three problems that we've got, the principal problems that we've got in relation to the pandemic, which is not over yet, the war in Ukraine, and of course the threat of inflation. So, no, it's different from what it was 10, 15 years ago, but there are similarities here. And, it's difficult sometimes, but we do need to learn from experience. And, there's two things you can do when you look back. And one is to repeat the mistakes you've made in the past. And the other is to say, well, let's try and do it better this time. Now, I'm reasonably optimistic that we can do that. I think, that central banks have got their part to play in monetary policy, obviously, but so too have governments got a role in relation to fiscal policy and also the political stance they take, if I might use that in its broadest possible term. So I think, Ranjit, what I'm saying to you is that we need to take a balanced view here. Yeah, there are things on the downside, but there are opportunities here that we can build on and perhaps learn from what's gone on over the last 10, 12 years or so, and perhaps see if we can't do better for the generation that's going to follow us. There are huge opportunities there. I don't for one moment, underestimate the particular difficulties we've got in Europe, for example, at the moment. But I think if we look at the positives here and learn to live with each other and work with each other, then we can be a lot more optimistic than would otherwise be the case.
Thanks very much. Thank you. Thanks very much, Alistair. Look, let me pick up on these points that you just made, actually, and take pivot to Japan. I mean, Alistair has emphasized just the importance that we don't lose sight of the significance of cooperation, and he's also said that the retreat into this notion that globalization is not working is definitely is not the right one, and instead there are several opportunities at play. Japan has always done a great job of never wasting a good crisis and using these crises as a catalyst for change. Can you, from your vantage point, tell us how do you see some of the developments in Japan, and provide that global perspective in the context of what we're discussing today?
No, and thank you very much. And just very briefly, I think, as Alistair said, the key point is actual coordination. And as many of you in the audience, remember, I mean, Japan has had this enormous balance sheet recession, this asset deflation. I mean, it's very interesting. I mean, with the collapse of the Japanese bubble, Japan in the 1990s destroyed more wells than they destroyed during the Pacific War. And yet the unemployment rate never really rose above 5%. Yet some of the leading Japanese companies continue to be, very, very competitive here. So the number one thing that Japan did learn the hard way is that the coordination between all parts of the government, and it's not just the central bank and the fiscal authorities, but it is the regulatory authorities as well that need to be brought to the table and that really need to have one team, one dream, and that's, I think, where Japan in the current juncture, while the world is going through various shocks, Japan actually has turned into a bastion of stability. You've got the strongest banking sector in the world. And it's very interesting because people talk about deglobalization. Well, that's not happening here in Japan. If you look at the BIS data on cross-border lending, for the last 6 years now, Japanese banks are the single largest supplier of cross-border credit in the world. And this continues to accelerate because the Japanese banks are actually very strong and sound. So there's no end to globalization, quite the opposite. There's a shift in the focus of globalization, perhaps away from China towards the ASEAN countries, towards the United States. But, from a Japanese perspective, having a healthy banking system and exploiting those international opportunities as, yes, European banks have retreated, and yes, American banks have retreated. That certainly has been a great success story, for the Japanese. The other thing that I think is very, very important is, when you look at Japan itself, I think there was one of the questions here about value, right? If I look at the corporate sector, if I look at the listed companies, I find deep value. Let's start with the price earnings multiple. The Tokyo Stock Exchange trades on a trailing price earnings multiple of 14 times and on a forward price earnings multiple of 12 times. That's about half as expensive as it is in the United States of America. So there is great value here. And by the way, the other thing that has happened here in Japan is not only the listed companies, but when you look at the unlisted part, entrepreneurship is really something that is being fully embraced. And again, this is a lesson that Japan's leadership has learned. It's not just fiscal policy, it's not just monetary policy, but at the end of the day, it's animal spirits. Can you actually create new startups and transform these startups into viable companies? And so Prime Minister Kishida is deliberately trying to turn Japan into a startup nation, which is very, very interesting. So the tax code is being changed so that angel investment, actually becomes much more tax efficient. And I think that's very, very important for policy leaders that, yes, you do have the monetary policy, you do have the fiscal policy, but in addition to that, it's the whole regulatory environment that at the end of the day needs to be focused on actually allowing entrepreneurship to come through. And I think that's something that's very, very interesting. And that's exactly happening, in Japan right now.
Thanks very much. Thanks, Jesper. That is certainly, very, very interesting. We're watching obviously developments very closely, in Japan. But let me sort of, and you mentioned this earlier. You talked about the some of the positives appearing in the context of Asia. I wonder whether you could provide a bit of your perspective on what are the challenges for the rest of Asia. Megan talked about China. Again, you have that view, and we have obviously audience members from everywhere, but there are questions around implications for Southeast Asia, etc. And so I'm just if I could get a little bit of your take on how are these developments playing out. Clearly we Alistair mentioned earlier on about the central bank challenges, but when we look at emerging markets, they're not a homogeneous group, right? At the end of the day, there is not a heterogeneity within emerging markets, and Alistair alluded to the significance of some of these issues as well. Some central banks have front-loaded tightening in EMs, a different set of dynamics being faced there. Asia, you're beginning to see the inflation pressures now beginning to appear, and a different set of and some of that tightening occurring. But how do you see this headwinds that we've talked about playing out for Asia?
Look, I think that, the interesting thing is that, actually, nobody, and certainly not the Federal Reserve, is very, very aggressive in its interest rate policy. This is a well-flagged, well-signaled, oh my God, how many speeches have we had, and are we going to do it, yada-da. I just remind you, if you want to crush a bubble, look at Japan. They raised rates from 3% to 8% in 8 months. That's how you kill a bubble. That's how you force a recession. And so the first point, is that, the Federal Reserve, the American policymakers are actually much, much more mindful of the potential stress in emerging markets, in emerging Asia Pacific in particular, if indeed the dollar borrowing costs, are going up. And so it's actually, and, fingers crossed, right, with all these cross currents that Megan outlined, we're probably past peak inflation in terms of the rate of acceleration in the United States. And if that's the case, then sort of the soft landing glide path in terms of US monetary policy, in terms of US interest rate hikes, can continue, which means that the emerging world, particularly here in Asia Pacific, is not going to be hit with a sledgehammer. And as a result of that, if you can actually mobilize more savings into infrastructure investment, transition, energy investment, as well as, a country like Indonesia, for example, is a huge focus for Japanese corporations as the next factory of the world. So this shift of the supply chains, right? You got to ask yourself, who are the beneficiaries of that? And yes, it's Vietnam, but yes, it's also a country that's been so far relatively unforgotten, like Indonesia.
Look, Jesper, thank you. I mean, look, it's interesting how much of what you've been saying resonates very much with the audience members who are sort of saying that, many other, parts of the world where they're at, as you can see, would benefit for some of your comments in the context of Japan. Let me turn to Kiran's thoughts here. And Kiran, you're in a really sort of important location, an investor perspective on this. I mean, how do you as major investor here navigate these risks in this very challenging waters that have been described? And the volatility has certainly been very, very high. There are a lot of concerns about the worries about repricing of risky assets that's occurring. But so tell us from your vantage point, how are you managing this?
Yeah, it's a great question, and we don't hold a crystal ball. So I think the one thing I will say that's unique to our profile as an investment fund is that we are our long horizon. So in terms of generally what we invest in, we look over the years as opposed to quarters and things like that. And so we are able to sort of weather volatility, I would say, and we clearly model, what an acceptable amount of volatility is in any given year. Having said that, a lot of the topics that we've been talking today, particularly around the geopolitical nature and the aspects, we have standard sort of models that we run looking at historical scenarios, but really what we also look at is the top and emerging risks. And I can maybe just give some insights as to what we see those as being, and certainly are looking to either refine our own thinking around these topics and model ourselves. So I just want to call out probably three things. And again, very, very topical in terms of what we've already discussed, but we've talked about inflation. So, the risk of key central banks around the world tightening of monetary policy. Clearly, we've talked about, Russia's invasion of Ukraine has increased the energy-based and food and commodity price inflation. And in terms of what we're really looking at in terms of tail events and scenarios is, well, I mentioned earlier, stagflation. So where we see a sharp rise in inflation and interest rates together with stagnant economic growth. But secondly, also, we're sort of re-looking at the 1970s inflation scenario, a sort of severe low to mid-teens level of inflation, and evaluating potential implications of these scenarios on our portfolio. We've touched on this a little bit in our call today, but it clearly as an asset manager, investment manager, but the sort of climate work that's happening around the globe. So the impact to the ESG, the environmental, social and governance factors are significantly driven by both the risks and opportunities that we're seeing. So, the impacts of all of the work that we're doing, not only globally as different investors, but also ourselves. We believe that the ESG related risks are some of the most significant that we face today. So climate change in particular presents a complex array of physical energy and transition risks, but it also presents opportunities. And so, again, that's something we're closely monitoring. And then again, as we've just really talked about, it's the whole gambit of sort of geopolitical uncertainty, and also the relationships globally. So particularly for us, we are very much watching, the US-China relations, Canada-China relations, which, and how those evolve. China's economic and regulatory reforms could continue to negatively impact our investments. Clearly, there's a lot of change going on there. And as this is really, the sort of broader impacts of Russia's invasion of Ukraine, that's something that we sort of monitor, very, very heavily right now.
Thanks very much, Kieran. Look, I can't not follow up on the point that you made, which I think is very, very important. And again, clearly also is something, worth having, a moment on. And that's basically around the ESG climate change agenda. I mean, obviously, absolute priority focus needs to be done. Are you concerned whether sufficient efforts are being done? I mean, in this regard, is that climate transition effort to some extent likely to now be, affected given developments around energy security, etc.? I'd be interested to get, sort of, again, it's a question that's also appearing from some of the comments the audience is making, right? Given the fact that, given the current economic backdrop, lots of pressures, around what emerging markets are having to manage, the issues around energy security top of mind as well. Does this somehow impact our focus on climate? The climate change agenda, the ESG agenda more broadly as well? Your thoughts, Kieran?
Yeah, and I'd love to hear others on this, but I mean, I would say from my thoughts and how I think at least we have approached it now, I think the biggest challenges obviously is energy security, as we just talked about. So, it's that whole green and transition energies, right? So what are the assets that can meet that criteria? And I think as a fund, we've done a lot of work on that. We have also been champions of the framework in which we do that and the regulatory sort of landscape of what this needs to look like, working not just ourselves, but clearly with the community around us to do that. Now, I think the challenge will lie in terms of the geopolitical aspects that we've talked about is how, again, globally, it is how that impacts other not only just other countries doing that in terms of their regulatory framework to do that, but also how other asset managers, again, this investment, world is impacted by that and their ability to do so.
Thanks, Kieran. Thanks very much. But let me pick up on Kieran's comment as well. She's asked for some other perspectives. Let me ask the panelists. Alistair, what are your thoughts around the climate change agenda in this context?
Well, look, two thoughts really. On ESG, I agree, and I think we'd all agree, it is vitally important that we actually implement it. And that's why it's important that regulators, for example, legislators, make sure that people are actually committed to delivering it. And important here too is being clear what it is we're measuring. What are the metrics here? So that we know that if someone says, well, I'm compliant with the ESG in one part of the world, someone on the other side of the world is doing exactly the same thing. Because otherwise, you want to avoid a situation where people lose faith because people claim to be doing something that is good for the environment, good for social policy and attitudes, as well as good for governance and so on. So yeah, I think there's something where there's clearly a following wind here. People want it to succeed, but we've got to make sure that we actually measure it in a way that delivers. I think Kieran also raised a pretty fundamental point on energy, and perhaps what is happening in Europe, for example, brings into very sharp focus what the problem is. And that is that a lot of European countries are very, very heavily dependent on Russian gas and oil. And for obvious reasons, they don't want to be so. But they've got it. They also are conscious of the fact that come this winter, a lot of their populations need to be confident they can heat their houses and so on. So you can see the dilemmas there. But I'm utterly convinced that if we're going to get ahead of the changes that we need to make, we must do everything we possibly can to reduce our dependence on carbon. And the whole question of nuclear energy, for example, which has always been, there's been two views on that. I think that is important that we start looking at that. But we've got to end our dependence. But I think we are acutely aware of the political drivers here. And, it's very easy for me to be sitting in a country that isn't so heavily dependent on that, to take a different view than if I was sitting in, Germany or France, for example. But, be in no doubt, as I said earlier, perhaps all this will encourage us to step up our efforts here to see what more we can be doing so that, ESG isn't just, that something people can happily sign up to, but it actually is implemented and it does make a difference. It can be, and it is being done. We just need to make sure we get more of it.
Thanks very much, Alistair, on that very strong point. I think we could spend an entire webinar on this particular discussion itself. Look, I'm very conscious of time, and I'd like to get some time for the audience to come in to the discussions later. But Megan, I'm going to turn back to you and get your reactions on the impact. Again, not just yours, but the audience members, panel members as well. I mean, global risk assets have started on a much more upbeat tone this week with the optimism around the rollback in restrictions in China, etc. I mean, we've seen some of this. We talked about the volatility before. We saw the S&P possibly going into bear market territory, but that's not happening. Seen some bounce back. I mean, I suppose the question really is, I mean, given what we're describing in terms of the global scenario, how much of that has been factored in by the markets in the context of the risks? Are we potentially like to see much more, impact in terms of risk asset pricing, appearing? I mean, again, some questions around, where S&P and the FTSE have been, performing. So to get your sort of sense on how markets are factoring these risks. Could I get your reaction on that, Megan?
Yeah, sure. A lot has already been priced in. I said in January in a presentation that I thought we would have a 30% S&P 500 correction this year, which at the time sounded outrageous and like a dramatic prediction. We're not that far off already. And for what it's worth, that takes us back to where we were last year. So, it's not that dramatic a prediction. I still think we will have a 30% correction. A lot has been priced in, but a lot will, I think there will be a ton of volatility going forward. That's the only thing I can say for sure. That will end up, just given the nature of a war in Europe and, lockdowns in China and elsewhere. We still don't know what other variants will come our way. I'm in Boston right now. There's a variant ripping through Boston that has an R of 8. It's unbelievably transmissive. And so, I think as we go forward, we'll just have a lot of volatility. I think that the risk is on the downside in markets. A few people in the Q&A asked about kind of the US versus the Eurozone. I should be clear, I don't think we'll have a recession in the US in the next 12 months. In the 12 months after that, I think the risk is higher. But Europe has been hit much harder by the Russian invasion of Ukraine than the US has been. And the risk of stagflation in Europe is much greater than it is in the US. In fact, it's my base case scenario for the Eurozone that there will be stagflation over the next year if you take stagflation to mean pretty weak growth and pretty high inflation. So I don't think there will be zero growth. I think it will just be very lackluster. And so, I think that in value terms, the US still looks more attractive than the Eurozone does in terms of equities in particular. I'll leave it there.
Thanks very much. Thank you, Megan. So there's still some room to go, given where we are in the S&P, according to your forecasts. I wonder whether there could other panelists may have views on emerging market issues. Megan mentioned risks of the high debt levels and capital outflow risks within emerging markets. I wonder whether anyone would like to be able to come in and make some comment on some of that. Jesper?
Look, I mean, I think you're absolutely right. The sort of rotation in the markets, has been absolutely spectacular. Very nice, very fast, very radical. That's what equity markets are supposed to do. And when you look back, I mean, the rotation was actually that the big outperformance that we've seen practically since the financial crisis of growth over value, right? That really for the first time in literally 20 years, that has actually started to reverse. And I think that as global liquidity, begins to normalize, as the central banks, rein in some of the excesses, that were created, during COVID in particular, I think that the value proposition, becomes much more interesting than the dreaming proposition, right? Sort of the dreams were easy when there was excess liquidity. When liquidity gets tight, you got to be focused on what can you actually do? What is the value that you actually contribute? And I think from that perspective, as an equity investor, I actually find that the emerging, particularly, I only know the emerging Asian world, actually looks much stronger because they're real companies now. They're real companies that have excellent governance. And it's interesting when people talk about ESG, they always talk about energy, right? Because that's tangible. Oh my God, we got to invest in the windmills, right? But the G part, the governance part, particularly at the corporate level in Asia Pacific, has actually improved tremendously. And, there's been changes in corporate governance codes, in stewardship codes, the role of activist investors holding management more accountable really means that when I look at, for example, Indian companies or even Indonesian companies, right, they're much more trustworthy, much better governed than they were, 10 years ago when we had the last, sort of Asian financial crisis. So from that perspective, I think that this soft landing glide path and the refocusing. I mean, my presentations right now are called B2B, which is not business to business, but it's back to basics. What is investment all about? It's not about Elon Musk dreaming to go to Mars. It is about, can you actually plan a factory, build a factory, deliver it on budget and on time? And if you're the supplier, if you're the construction company behind that, I'm going to give you money. That's what it's all about. And that's where I think Asia Pacific in general, particularly India and Indonesia, I think stand out as a great investment opportunity.
Thanks very much, Jesper. Alistair, let me come to you with another question. I know you've talked about, issues around the differences this time around, but there is a question, around what central banks are going to do, including an audience question on whether there is greater risk to central banks' independence moving forward in some of the G7 countries. So, I wonder, how you would respond to that particular question, and also, how you see central banks who are going to be very important in the context of, trying to manage some of the scenarios that we've talked about.
Well, the short answer to your question is I do not see central banks in the G7 returning to being, the province of the government of the day, because, frankly, people have probably got more confidence in central banks than they do in the day-to-day governments. And as I say that as somebody who served in a government for 13 years, and which actually we made the Bank of England independent. There's been a lot of talk. Speaking the UK experience. But you're also seeing in the United States of people being critical of the central bank. Well, I think that's okay. It's perfectly healthy. You can't have a situation where you have any institution say you cannot criticize it, no matter what it happens to be doing. But I think you've got to avoid crossing a line where you actually contribute to an undermining of confidence. I said right at the start that I thought central banks generally were faced with something of a conundrum, at the end of 2021. And they were anxious to ensure that they didn't do anything that might have stalled or even set back the recovery that we could see was going to be taking place as the situation with the pandemic was improving. And there's a lot of people who say, well, you should have done this, you should have raised rates before now. There's a perfectly legitimate criticism, but I understand why a lot of the central banks were cautious. But as I said to you, I think the greater, challenge to our recovery and getting through all this probably lies more with governments rather than their central banks. That's why, I emphasized the need for us to remember that international cooperation can go a long way to restoring the sort of confidence that you want. And certainly, when you look at many of the drivers of inflation in Europe, as Megan and Kieran has said, it's putting up interest rates isn't going to reduce the cost of interest rate for energy, for example. That is being driven by a conflict to a very large extent. So I think the answer to your question, Ranjit, is no. I don't see, the position of central banks and the G7 being undermined. I think that there's a greater burden, though, I think, on elected governments to make sure that, firstly, they take the opportunities that are there to be taken, but also to ensure that the consumer has confidence. Jestra's point about in a large part of the world, there's lots of people who've got a lot of money to spend. They will spend it, provided they're confident that what they're doing is the right thing. Very often that depends on the general atmosphere that a particular government can create, not just within its own country, but within a region. And I think we've got to bear that in mind.
Thanks very much, Alistair. Thank you very much for that. Look, I think we are now, at about another 10 minutes or so, and I've tried to pick up some of the questions that the audience have posted collectively. Let me spend a few minutes to sort of maybe pose a couple of more questions to the panel members. Megan, there is a question around whether you could make a comment on the real estate markets. And how do you see some of these pressures likely to impact the real estate markets and the property sector? I suppose this is top of mind in many countries. You have thoughts on that, Megan?
Yeah, sure. So, as rates go up, mortgages will get more expensive. And so that the idea is to take some air out of real estate markets. And we're already seeing that happen in the US off the back of rate hikes. Mortgage rates are above 5% now. That's way higher than they were even 6 months ago. And that's part of the purpose. Is there going to be a bubble burst, though? I don't think so. So I think it will be, just a fizzle rather than a burst. I know in the US in particular, I've dug around a little bit on this. About 40% of Compass, a big national realtors, transactions, they say residential transactions have happened in cash, in which case rates going up won't affect them much. But I've asked, is it really cash or is it some kind of financialization of cash? And I'm hearing more and more about banks writing proof of funds letters off the back of initial loan applications. And so banks, because you can't get a house if you don't offer cash. And so banks are saying, well, we'll make it look like a cash offer, even though we haven't fully vetted you for the mortgage. Now, if you use your equity portfolio as part of the collateral for your mortgage and it goes down by 30% between when you submit the application And when you actually get the house, that's going to be a problem. So I do think that there are some dislocations that we'll see in the markets as a result of that. I don't think, well, and of course the banks aren't holding this stuff on their balance sheets. They're slicing and dicing it and selling it off. So that sounds familiar if you follow the global financial crisis. I don't think this will be another repeat of the kind of subprime crisis that we had before. I just think it will cause some market dislocations. And if there are really major market dislocations as a result of this in the US or even in the Eurozone, I don't think the same is happening there. But I do think central banks have the tools to step in pretty quickly now. I don't think central banks care at all about equity market corrections. The Fed certainly doesn't. They're happy for the S&P 500 to correct by 30%. They do care about credit market dislocations because those could become systemic. So if we saw those kinds of dislocations, I do think that the Fed put would still exist. Doesn't exist in equities, but does still in credit, I think.
Thanks very much. Thank you, Megan. Let me wrap it up and basically, just pose to the panelists just a question on, beyond inflation in absolute terms, what would be one key metric or indicator that you're going to be keeping a close eye on over the coming weeks and months? Let me start with Megan and then I'll move on. Megan?
Yeah, I'll be watching the labor market again, because an uptick in unemployment is the best indicator we have, better than any economist in terms of when a recession might be coming. And in the US, I mentioned we have 11.5 million unfilled jobs. So I think even with tightening, it's going to take a while for the labor market to deteriorate. It's still healing. In the Eurozone, the labor market has healed a lot more, actually. But there too, I think an uptick in unemployment is the best indicator of a downturn. So I'll be looking not just at the unemployment rate, the labor force participation rate is particularly important for the US, and wage growth is important across the globe.
Right. Kiran?
I'm not sure if it's a metric, but certainly how discussions progress around, again, we've talked about it, but energy scarcity. I think that's not only just I think that wraps up into a few issues globally, how sort of different countries discussions go in terms of tension. I think that's really important, but also just in terms of, again, a driver of inflation, like in terms of energy cost, its contribution to that and how long that continues to play a role.
Thank you. Jasper?
I watch like a hawk the renminbi, the Chinese currency, because I'm scared out of my mind if indeed the slowdown in the People's Republic of China forces a devaluation of the renminbi. If China starts a currency war in Asia, I'm going to have to hold on to my hat, and all of the investment thesis are going to fall by the wayside. So watch out on whether indeed the slowdown in the People's Republic of China forces a policy response, forces a devaluation. I don't think so, but thinking is not.
Thank you, Jasper. Thank you very much. Alistair?
Yeah, look, all these things are important. And I just add to it, and that is looking at surveys of confidence, whether it's employers, employees, consumers, because just at the moment, I think that will drive a lot of what's going to happen. The other thing that you need to look at, which doesn't have an indices to go with it, is the geopolitics of the world, because what happens then will govern a lot of what my fellow panelists have been talking about.
Thank you very much. Thank you, Alistair. Thank you, everyone. I've enjoyed, sort of listening to everybody's views, and I thank the audience for their participation as well. But really excellent presentations and interventions, Megan, Kiran, Jasper, and Alistair. Really, thank you so much.